I am joined once again by Sam Burns, founder and chief strategist at Mill Street Research. Sam, great to have you here. How have you been?
I'm good. Thanks, Jack, for having me back on.
It's my pleasure, Sam. It's been just over a year since you came back on Forward Guidance. What's your outlook right now when it comes to the macro, when it comes to assets, stocks, bonds? Everyone's talking about the soft landing. Inflation's coming down. The economy's somewhat resilient so far. What do you think? What's your sort of midterm outlook for 2023?
Yeah, well, I'd say certainly the outlook coming into 23 looks a lot better than it did going into 22. The indicators that I look at, looking at, say, 1 to 3, maybe 6 months out, are much more bullish now than they've been for quite a while, probably since mid 21. We've seen these kind of readings on the on the kind of risk on, risk off indicators that I look at. So that's a lot more positive. I think we're coming off of a period of heavy pessimism among investors and a lot of headwinds from the Fed in particular. I think that's a lot of that's going to ease, and as sentiment starts to improve, you've got the scope for equities to do better in the next few months. I think corporate earnings are the risks now. I think they'll be soft but not disastrous, and I think the economy is probably in better shape to withstand the Fed's rate hikes now than they would have been in past cycles. Certainly the 05, 06, 07 period, when the last time we saw these kind of rate hikes. So I'm relatively positive compared to what I think the consensus has been. Not super bullish in the sense that I think the economy is going to go through the roof. But I think equities can do better now, certainly in the first half of this year.
So yeah, tell us a little bit about your process. When you said the indicators you're looking at, risk on, risk off, what are those? And then I know your specialty is looking at analysts' earnings revisions, which is a little bit complex. So we'll save it for maybe the second half of the interview. But we are in earnings season, so that's why I'm so happy that we're talking right now. But yeah, first, what is your process in terms of the indicators, and then how does that impact your outlook? You said you think you're pretty bullish on stocks.
That's right. Yeah. So those indicators and kind of the more tactical, macro market indicators are looking at both the trend and momentum in equities, which has certainly improved. Volatility has been coming down. Those are all tends to be good signs over the next few months. Also seeing things like credit spreads come in. So, cross asset, movements are supportive. And we're seeing things like industrial metals, some of the commodities that are sensitive to growth have picked up. Some of that is capturing the fact that China is looking to try to reopen after being heavily impacted by COVID and their real estate issues. So a lot of those things are things where they had been very negative and are getting maybe less bad or picking up from low levels, and you see that in sentiment as well. The other thing, of course, is the Fed, where you've had really heavy headwinds. The Fed has been aggressively trying to not just raise rates but keep stocks from going up essentially. For most of the last year. It looks like they're moving towards the end of that process. And we even actually saw the Bank of Canada doing that probably yesterday, kind of moving to the sidelines. So I think February, March will be the last of the rate hikes. And that's showing up in the indicators that I watch as well, looking at the difference, say, between the 2-year Treasury and the 3-month Treasury yield as a measure of where the market thinks rates are going to be going. That's gotten a lot better. So both the kind of macro interest rate, commodity backdrop, as well as the equity indicators themselves are looking a lot more favorable now and coming off of a really rough time, late last year.
Right. A lot of the data that was very negative last year, people talk about the 2 quarters in a row of quarter over quarter negative real GDP growth. Real means inflation adjusted. The reason it was so bad is because inflation was so high. Actual nominal growth now, we're recording Thursday, January 26th, when we had the apparently good reading of, I think, 2.9% real GDP growth for fourth quarter. Nominal growth was lower. It's just that inflation was so much lower as well. So what you're subtracting by has gone down as well. How much of this transitory Goldilocks or soft landing, depending on how much of that is due to this somewhat rapid fall in inflation? And to what degree are you worried that economic growth will start falling quite sharply? Because rate hikes do have a delay. They're, as the Federal Reserve constantly remind us, they act with a lag. As well, so many of the tailwinds of 2020 and 2021, the consumer has flushed with cash. Those are ebbing away slowly. The PMIs, the Purchasing Managers Index, are now in contractionary territory. They've been falling, pretty much every month. Housing, I'm throwing a lot of bearish stuff at you, but how do you sort of counter those bearish arguments that I just said?
I think it's not necessarily that the economy is going to accelerate and go gangbusters again. It's more partly relative to what I think probably the expectations were over the last few months. That not as bad as expected is in equity market terms good, and also I think that there are offsets potentially globally. Europe is holding up better than expected. They may dodge a recession this year, which was very not the consensus even a couple of months ago. China might stabilize at least and do a little bit better, which will help that region. So when I look globally at even at the earnings estimate revisions that I look at, they're negative, but they're more negative in the U.S. actually than they are elsewhere, which is unusual. And I'm still seeing a cyclical tilt in some of the sector profiles of earnings estimates, meaning that the more cyclical sectors like financials or energy or industrials or materials, those are actually seeing somewhat better than average revisions, or at least less negative than average. Whereas the growth sectors, tech and communication services and so forth, and even some of the defensive sectors are seeing worse than expected revisions. So that all kind of tells me that it's not a purely defensive, economy's going into recession kind of profile. It's much more mixed, and therefore you have to, pick and choose. But I think it's there are some offsets to some of this. Partly some of the leftover from stimulus and the Inflation Reduction Act and some of the other, spending bills that have been put through that will take time to show up in data, but I think are relatively supportive. And so I think there's a little bit better fiscal support, at least for now. That may change because Congress is now split. And I think the market, the economy is better suited to withstand the rate hikes than they were in the past cycles. And I think a lot of that's already happened in terms of housing and autos and things like that. Some of those interest-sensitive, markets have already responded to a large degree. And so if the Fed does pull back and long-term interest rates have already started to fall, mortgage rates have pulled back a bit, I think there's enough there to kind of balance things out so that you don't get, a severe recession. I think you get maybe a mild either recession or kind of, roughly zero-ish growth for a while, which is, again, not great, but not the end of the world. And so a bit of P multiple expansion will be enough to hold equities up.
Sam, I want to draw attention the point you said about cyclical stocks versus defensive stocks. This is a key thing analysts such as yourself look at, where in a recession, people are still drinking Coca-Cola. They're still doing, buying toothpaste and stuff like that. So companies like Coca-Cola and Procter & Gamble, staples, they do well. You still have to pay your electricity bill. Whereas things that you buy that you don't need every day, like housing, cars, jewelry, those don't do as well. I want to throw something at you though. So I presume you're referring to the fact that cyclical stocks for the past few months have been doing well. Copper miners exploding higher because of China. Home builders doing well, very well. That actually surprises me as well. What about the fact that secular growers are companies like Apple and Google, Microsoft, because they can grow in any environment. But to what degree do you think though that those like mega cap giants are actually cyclical now, because they've become so big that they're not immune to macroeconomic headwinds? And a lot of the things in the cyclical indices are things like copper miners that are surging because the price of copper is exploding higher because of the reopening in China, but that doesn't necessarily mean that the economy is strong. Likewise, airline activity, when it's high, normally indicates a good economy, but there's just so much pent up demand that you still can have airlines printing money and the economy very, very poor. So I'm wondering what you think about that.
No, you're right. And there's a lot of mixed signals out there. And a lot of that is just the lagged effects of all the distortions and volatility caused by COVID and the response to COVID, and then Russia and then China. All of these major global shocks have thrown a lot of volatility into the macro data, both the real data and inflation, as well as earnings data. And so there's still a lot of things that are kind of the second order effects from that we're still seeing. And so whether it's, the tech stocks, a lot of them got, bid up in the equity market, but also got, so their earnings jump because of all the work from home. Now that's kind of starting to reverse a bit. Those winners from, COVID which are also tend to be viewed as secular growers, but have now had to sort of go the other way. And some of the more cyclical areas that had gotten beaten up are now doing better. Now, yeah, you're right. I mean, the magnitude of the move in copper miners or home builders and things is not enough to offset maybe the weakness in Microsoft and Apple and some of those names like that, because they are having to adjust to both slower growth and the fact that they may have just overstaffed and kind of gotten too big, both in actual terms and in market cap terms, over the last year or two. So I think you're seeing a rebalancing and kind of a relative movements between, say, value and growth and some of the sectors going on, and that's why Exxon is now back to being worth more than Tesla, and things like that you see that are more rebalancing than meaning everything is going down and it's a broad scale recession. So I think that's the important part is seeing this as rotation and also just volatility in the numbers that we're going to have to just kind of wait for that to settle out a little bit to really get a better feel for what's really been going on, because even the employment data or GDP numbers are probably going to get revised substantially over the next 6 to 12 months, and we may have a different view of what's been going on lately. But I think if the situation in Russia, situation in China, and COVID all at least sort of stay stable or improve a bit, then I think some of those shocks are going to go away, and you're going to go back to sort of the slow but steady growth that we had prior to COVID. It's probably more the resuming that steady state as we go in the next year or two.
I now want to ask you about your valuation of stocks relative to bonds, because a year ago when we spoke, the first time you came on Forward Guidance, bonds were at, let's just say, 0, and stocks had a price to earnings ratio of something like 30, and a price to earnings ratio of something like 30 is the same as it yielding 3.3%, and if a bond yields 0, that's like infinity price to earnings ratio. If the 10-year was at 1%, that's a PE of 100. But then stocks are more risky, so you have to lower the valuation from that. However, stocks also grow, and bond earnings do not, of course. So you have to adjust for that. But so there are times, and most times this is the case, when stocks are attracted to bonds because bonds don't grow. But what about the fact now that risk-free rates, other than duration risk, have risen so much? So you can now get 4.5% by just parking your money in a money market fund. So suddenly, this company that's making this futuristic robot that's going to come out in 2028 is no longer nearly as attractive. And also just the fact that, if earnings are contracting, revenues are still going up, sales growth is still high, but Microsoft made less money in Q4 than it did in 2022 than it did in Q4 2021. I don't want to get into individual companies, but when you look at the S&P 500 total earnings, what are your personal views on S&P 500 earnings? And the S&P 500 is now at, let's say, 4,000. If it earns $200 in 2023, that would be a forward price to earnings ratio of 20. So I want to know what you think about the valuation, the forward earnings, and I also want to know, perhaps even more importantly, what is your view on what the other analyst thinks? Because this is where I think your specialty is at Mill Street Research, is meticulously tracking other analysts' forecast for individual stocks as well as the broader index, and that is very important.
That's a very important stuff, and certainly the earnings story, kind of the backdrop is become much more important now. Last year was more about the Fed and interest rates and the kind of the valuation compression because of that, and now this year it looks like it's going to shift from being kind of the Fed problem to being an earnings problem potentially. So yeah, I think earnings estimates for the S&P 500 for most stocks have come down pretty substantially already from where they were, say, even just a few months ago, and a lot of that has been driven by margin compression. So forward estimates of margins have come down quite a bit already, because as you mentioned, sales estimates have actually held up relatively well for the index. Some of that is just the nominal, inflation kind of holding them up, but margin compression has been pretty substantial already. Now, it could have farther to go in the sense that S&P index margins, at least on a forecasted basis, are still not quite back to where they were pre-COVID. They were just below 12%, I think, before, in late 2019. And now they're getting down to sort of the mid 12% range, 12.5% range, after having been as high as 13, 6 months or so ago. So there's definitely been a lot of adjustment already in that. I think there could be a bit more. But I think that even if stocks or the S&P only earns $200 a share, which would be below consensus, where consensus is now, I think the fact that the 10-year yields have already pulled back to 3.5% on the 10-year Treasury and could go even somewhat lower if people think that the Fed will in fact start cutting rates either late this year or next year. I think that valuation could move in favor for equities. But yeah, my longer term model that you kind of alluded to, where I'm looking at the long term corporate bond yield adjusted for inflation and compare that to kind of the longer term outlook for S&P real earnings growth. So after accounting for inflation, that model is actually still pretty. It shows low implied growth, meaning that people are expecting about zero real growth for earnings over the next, say, 10 to 20 years. Whereas I think kind of maybe 1.5% to 2% is probably a fair reading. And the actual trailing 20-year reading is closer to 4%. So I think the markets are already pricing in pretty low expectations for long run growth, not just this year, but longer term growth, and real bond yields after accounting for inflation and the fact that credit spreads have come down and that kind of thing still aren't really that attractive compared to what you could potentially get from stocks over the longer term. So when I see the tactical indicators that I mentioned earlier and this kind of longer term relative valuation indicator still showing pretty low long run real growth expectations, meaning it's a very low hurdle the market's putting on growth right now, then that's usually a pretty supportive backdrop. And actually, we've seen stocks outperform bonds most of the last, say 6 to 12 months, even though neither has done that well. On a relative basis, stocks have actually held up better, which is unusual. Usually when interest rates go up this much, stocks lag, and they haven't, because you've got this sort of distortion or this gap in earnings versus bond yields, and that's still relatively favorable in my work for stocks. So I think longer term stocks still look better than bonds. I think maybe neither one of them will do super well in the sense of meeting their long run returns, average returns. But I think stocks are still a better place to be, at least for a while now, than bonds based on relative valuation.
So if we say that in 2022, the S&P 500 earned about $215 a share, again, we're still getting that Q4 data. So this is just an estimate I'm getting from an estimator. The rough estimate, it appears, for 2023 earnings for the S&P 500 is 225. Do you think that the S&P earnings will realize that, over-realize that, go higher, or under-realize that? And then also, what do you think the expectations will be once that happens? Because if, let's say, you go from $215 a share in 2022 to $215 a share in 2023, okay, that's no growth. But if I saw that, I'm an analyst, I'd say I'd expect it to go down, because that's the trend is that the rate of growth is going down until we'll go negative. So yeah, what do you think about just the broad picture of earnings for S&P 500? Can you give us a specific number? Like, can you comment on the 225 that's expected?
Yeah, no, I'm looking at the FactSet numbers, which is mostly what I look at. They build the aggregate indexes estimates up from the bottom up analysts. And yeah, the 2022 number is looking at 217, and the 2023 number is 225, just over 225 right now. So that would be moderate growth priced in at the moment. So if the 225 comes down to say 217 and you get zero growth, or even if it's slightly less, I think given that people were expecting that the tightening and everything else that was happening would produce a bad recession and down 20% earnings, was what at least some people have been talking about. I think that would be a relatively benign outcome. And so I think, that would be equivalent to a soft landing, essentially, if you got even a small, negative single digit growth in earnings for this year, and then maybe a little bit of growth in 2024. So you might have a sort of, plateau in earnings, but not a drop off the cliff kind of, result. I think relative to say what expectations have been by some of the other strategists and some people in the market, that would be okay. It would be a bumpy ride. It means that 2023 will be a back and forth between basically the effects of interest rates, which are going to be, maybe potentially getting better, and earnings, which, their estimates will be moving the wrong direction. But like I say, the intensity of the estimate cuts lately, particularly for the large caps, has been pretty heavy. So even if you saw the pace of cuts be reduced, so kind of like a second derivative argument, that instead of cutting at a heavy rate, they're cutting at a lesser rate. Even that would probably be enough to keep a bit of a floor under stocks, because that's typical. The analysts start with a high number and then kind of work their way down over the course of the year as kind of reality comes along. That's to be expected. I mean, most investors kind of anticipate that to some degree. Whereas it's when they get the real major cyclical turns wrong that you run into sort of issues. I don't see that happening as much this year because I think the Fed and interest rates and all that will be less of a swing factor as like they've been in the last couple of years. So barring any new, major COVID outbreaks or land wars in Europe or things like that, I think you probably will see more stability in the estimates and therefore a little less volatility in the equity returns that go with it.
Right, so the analysts who you follow, who look at, this is my outlook on Apple's earnings, this is my outlook on Microsoft's earnings, they have a slightly different incentive than, let's say, someone like me who, or someone who wants a lot of attention, who making bold calls, and because that's what people are incentivized to do when they're that's very different from an analyst who works at a big bulge bracket bank who is upgrading Apple. They just want to stay in the role that they are in, so they don't tend to make bold calls. I mean, correct me if I'm wrong. And if Apple, like in March 2020, the global economy plunges into a severe recession, they're going to downgrade sharply. And then if you have a miraculous rebound in corporate profits, they're going to upgrade sharply. So they're kind of always catching up to the actual reality, because to make a prediction about the future is, you could be wrong. And if you could be wrong, that's not good for your standing and your reputation with your firm's clients. If you make a bearish call or something like that. So I imagine. So first of all, I want to make any comment about whether to what degree I said was correct, or if you disagree with anything. And then also, if it is the case that analysts are always going to be catching up, racing ahead, or they have to slow down, and their forecasts are too bullish, where are the analysts right now? Do you think that downgrades are coming for earnings, or do you think upgrades are coming? In June of 2022, it was all upgrades because they were so bearish and so pessimistic, and the economy rebounded so quickly. Now, do you think it's the case that their expectations of where earnings would be a few months ago would have to come down, or what do you think?
No, I think you're right. I mean, analysts definitely do have certain, kind of job-related constraints or biases or incentives in terms of the way they behave. And in some respects, the work that I do in looking at earnings estimate revisions, kind of takes advantage of that to some degree, in the sense that seeing what analysts are doing now can help you figure out what they're likely to be doing, say, a month from now or 3 months from now, because they tend to kind of go in trends and act as a herd and move in one direction for a number of months at a time. And so what I found is that you're right, at inflection points in, say, the economy, or major swings, they tend to be a little bit late, meaning that they can't predict. Certainly can't predict things like COVID, but even recessionary periods, things like that, or when the Fed suddenly shows up and says, "Oh, we're cutting rates to zero and there's free money everywhere," then they have to respond to that, and then it takes a little while for them to catch up. Now, in more normal times, when there's not as much sort of big picture macro swings going on, they can do a better job of forecasting earnings. But really, the focus of my work is not what the level of their earnings estimates is, meaning what number they expect. It's the changes. It's the revisions to the estimates, and usually those do have helpful kind of forecasting ability for returns. And because once they do start moving in one direction, that tends to mean something. There's some new news that's happening that's causing them to raise their estimates or lower them. So I think the important thing, the most useful tool in terms of using estimates, is on a relative basis, meaning all the analysts kind of have these similar biases and incentives. But in somewhere they'll be raising estimates, somewhere they'll be lowering estimates, and seeing where those that relative activity is really the key, in the sense of finding out which sectors or stocks are more likely to be outperforming or have fundamental tailwinds. So I call it fundamental momentum, kind of looking for where the estimates are moving in the right direction, whether they're were too high or too low before. If they're moving up, then that means something positive has been happening, and that's probably going to show up in the stock prices, and vice versa for negative. So I look at it much more on a relative basis than kind of looking at the absolute numbers in aggregate. But that applies to even to sectors and to regions, to kind of big picture views, as well as to individual stocks. So I think it could very well be the case that estimates come down in aggregate over the next few months, but maybe at a slower pace. But I think it's more the relative picture that's more important, and that's where you can get some of the real kind of forecasting ability and kind of the alpha for building portfolios. And that's what a lot of my work is driven by, is looking at kind of where their changes to estimates are, and which are the strongest and which are the weakest.
And what are you seeing there?
Big picture has been that there's been earnings estimates have been falling pretty much for every sector, not every industry, but the majority of them. So the kind of the backdrop is that estimates are falling. So it's where are they falling least, or maybe rising, and where are they falling most? And so I've seen areas like energy, of course, has been strong for quite some time. It's kind of been losing some of its momentum as oil and energy and natural gas prices have been coming down. But on a near-term basis, their estimates are holding up fairly well, particularly for like refiners and places like that have and some of the energy equipment names that have longer-term contracts. Some of the financials have been doing well. They've had much better net interest margins for a while. All that's starting to come back a bit. But the better stock markets will help the kind of the investment banking and the capital market side. And industrials, some of there, including some of the transportation-related areas, have been holding up relatively well. Some areas of consumer discretionary. Now that excludes things like Amazon and Tesla, which are actually part of discretionary sector. They're not tech stocks, strictly speaking.
But they're the biggest part. They're the biggest part, right?
Right. They're the biggest weights. Yeah, exactly. And so you look at the cap weighted numbers that are skewed by big names like Amazon and Tesla. You can see a different picture sometimes than what you see if you look at, say, the whole sector on an equal weighted basis. It's actually very true right now in technology, where the cap weighted, the really big names like the Apples and Microsofts have been weak. They've had below average revisions. And the same is true in communication services, where Google and Meta and things like that have been weak.
But below average stock, as in the downgrades are higher, or below average as in terms of the upgrades are smaller?
So they have more downgrades in among the large cap tech and communication service stocks. But they actually, if you look at the equal weighted tech sector, where you're not skewed by those big cap names, you actually see they're actually relatively above average. So a lot of the communication services or communications equipment and software names actually have better than average revisions now. Now some of them are expensive, but they actually are holding up relatively well. But a lot of them are kind of mid cap names or smaller cap names, and therefore they don't have the weight that some of the big names do. But there are pockets of strength in terms of estimate revisions, even in what you would think will be the weak sectors in some of these areas, because they're skewed by a few of those really big names. And so I think it's important a lot of times to look below the top 10 names or the really mega cap names and see what's going on below the surface, because you can see you get very different pictures sometimes from those metrics, and though the equal weighted numbers in some of those sectors look better than the cap weighted numbers. And that's true in general. I mean, the average stock, even in the S&P, has done better on a return basis than the cap weighted indexes have. So the smaller cap names, even amongst the larger cap indexes, have been doing better, which tells you that it is somewhat specific to some of those large cap names that we're seeing the downgrades. And so you can see that in those relative numbers as well.
So I understand, there's some alpha in the financials and the energy sectors. Those revisions are stronger than in the tech sector, and within the tech sector, within the discretionaries, the smaller market cap companies are performing better than the larger ones. And so you could do that. But when it comes to macro, you said pretty much every single sector, maybe with the exception of energy, is downgrading. What about that is bullish to you? And you also used the term relative, which I wonder, could you explain that a little more?
Right. So right now, if you just look at how many analysts have raised versus lowered their estimates on a forward 12-month estimate basis, for all stocks across the 2,300 stocks that I track in the U.S., on average, the average stock is seeing its estimates fall. More analysts cutting than raising, and that's true on average in all 11 of the sectors, even in energy now. So it's just mostly a matter of degree of how much they're cutting, how broadly they're cutting. In some sectors, there's basically a very small majority of analysts that are cutting, and in other sectors, there's a much bigger majority that are cutting. And that's what I mean by relative, is that because we're in a kind of an earnings slowdown period, and you're coming off of a very strong period from 21 and early 22, it's natural to see earnings estimates come down, and certainly more analysts cutting than raising because the Fed's been raising rates and all these other reasons we know why the economy is slowing. So that's to be expected. And so on a relative basis, what you're really looking for is where are analysts cutting less, or where are they cutting more? And so when I look at the profiles, we see energy and financials, industrials, some of those areas, and some parts of technology are holding up relatively well. Consumer staples has actually been improving, I think partly because of the fall in gas and gasoline prices, and also natural gas prices, which affects their packaging and transportation costs. So I think there's a lot of things that are shifting right now. But then you've seen that the things like utilities, but also communication services, a lot of healthcare, those have been relatively weak. You've been seeing a lot more analysts cutting estimates there than in some of the other sectors. So that relative picture is very important, because if you just say, well, analysts are cutting, that's bad, I'm going to sell all my stocks and go home, you might miss a lot. And so I think, and particularly for portfolio managers who have to be invested in stocks, they can't sell everything and just sit on the sidelines. They need something to buy. And so they're looking for the relative performance trends. And you actually are seeing, some of those sectors hold up relatively well, and some of them are outperforming on a relative basis. And so that's why it's important to watch those things on a relative basis rather than just looking at the kind of the big, the overall index numbers and stopping there.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present, because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. All right, so I want to throw three things at you, which I'm actually relatively constructive on, as you might have gathered. I'm a little bit bearish, but Chinese equities, gold miners, and then airlines. I noticed that the businesses there appear either very strong or the rate of change is very positive in their favor. So I'm wondering what your tracking of analyst estimates would say about those three sectors.
Gold prices have jumped, and so that's been sort of helping the gold miners. I think some of that is tied, of course, to the U.S. dollar having weakened. That tends to be, a boost for gold prices in other currency terms. So I think you're seeing some of that shift from the very strong dollar environment we had until October, November last year, into sort of a weaker, at least stable dollar environment now. China, to some degree, is coming off very, very, weak, period, last year. China had some of the very weakest earnings estimate revisions across the whole global, picture that I look at for a long time, and still does to some degree. What we've seen there is that actually some of the large caps in China have looked better on revisions, but kind of the average Chinese stock is not really that strong still. And hasn't done as well as some of the big cap names. So you have to be, quite careful, kind of what you're investing in and how you're doing it in terms of exposure to China. I think China is going to have a bumpy road. There's still a lot of kind of political risk there in terms of, policy. The real estate market is still definitely a risk there. But, to be frank, you could say the same for Canada. Their real estate market is under a lot of pressure. Prices have been very, very high and are starting to come down, and their banks are very exposed to that. Much less the case here in the U.S., relative to, say, 2007, 2008, where we kind of went through that already. I think China is going to be bumpy, but it's definitely less bad than it was. So again, the second derivative looks better. I've been underweight emerging markets in aggregate for a long time now, and still am, but I'm less so now because of that sort of incremental improvement in China, and because some of the other areas outside of China are looking better. And so, and then you just mentioned, airlines and things like that. I think fuel prices coming down helps them. And demand for for travel and services, people wanting to go places, are certainly helping them as well. But so I think there's some very specific things that are going on with gold and China and things like that. Some of it is related to reversals of what happened last year, and I think that's going to be a theme to some degree this year. Is a lot of what was the problem last year is less of a problem this year. So that's going to be China, to some degree Russia and energy costs, and the Fed. Those are all fading, and now it's more can companies grow organically without stimulus? And I think that's what we're seeing right now is kind of where is the steady state going to be for some of these specific industries, but for the overall economy of once you don't have stimulus and you've dealt with higher rates, where do things settle out? And so China's trying to stimulate to some degree, unlike here in the U.S. and in Europe where we're still tightening. But I think there'll be some offsets to that as the real estate market adapts to the new reality.
Right. Yeah. The one thing giving me pause on China is the fact, as you said, it's the large cap stocks that everyone knows about, Alibaba, Tencent, that are leading the charge. And the companies that are much less well known to Western foreign investors are kind of not moving at all. So that gives you pause like, oh, what if it's a bunch of portfolio managers in London and New York who are like, I know I'll buy Alibaba, but the actual Chinese nationals who are could buy local shares, and they are intimately, if they work at the company, intimately aware of the economy and then the earnings, they're not following suit. So it's interesting on China. I know also you're less underweight emerging markets than you historically have been, but you're still underweight. I know you've been overweight non-US, non-emerging markets. So I guess that's what, Europe and Japan. Why is that the case? And then also, can you explain to me what is going on in Europe? Because I, as many, expected Europe economic growth to stall out, particularly in places like Germany, which were very dependent on Russian natural gas. Russian natural gas has fallen like a stone. Interestingly, a lot of natural gas producers, the stocks have not gone down, which is interesting to me. But and the euro, the currency collapsed, but now it's surging back. What is going on with the European stock market? What's your outlook, and how is it shaped by the earnings as well as the earnings estimate, which, as viewers will know by now, you track very closely?
That's right. Europe's been, I think, a surprise to a lot of people to some degree. It's definitely held up much better than I think the consensus had been for much of the last year or so. Everyone, like you said, was expecting that the energy crisis caused by Russia's invasion of Ukraine would really just knock the whole European economy over, and they'd be in a severe recession even by now, and that there would be no way to avoid it. But what I think has transpired is that the preparations they made over the summer and fall to build up their natural gas storage and try to reduce usage, and a lot of things that they've done have kind of paid off, and they've gotten lucky with a much milder than expected winter, which has meant that the energy crisis has been less bad than anticipated, and industrial production, things like that, even in places like Germany, has again much less bad than expected. It's slowed and contracted to some degree, but it's much less negative than it was expected to be even a few months ago. And so I think that means that the stock market has been able to outperform because it was priced at 11 or 12 times earnings fairly recently, and that's expanded somewhat, but it's still pretty cheap because everyone was assuming that there would be no growth in Europe for a long time. And so I've been seeing that in actually the earnings estimate revisions for several months now, where you look at the kind of the regional profile of earnings estimate revisions, and again, negative in most places, but Europe was much less negative than everywhere else, particularly Europe ex UK, the continent. UK has been a little bit weaker, but still above average. And I think that's partly because of what's happened with the energy, and partly because Europe does not have the Apples and Googles and Microsofts that we do in the US. They're just not, they don't have tech giants the same way. They don't have the big cap growth stocks the way we do. So for a long time, that hurt them on a relative basis because they didn't have that kind of growth the way the US markets did. But now it actually may be working a little bit to their benefit on a relative basis because they don't have those stocks that are under pressure here in the US to weigh down their equity indices. They're actually more exposed to financials and industrials and to some degree energy and things like that have been outperforming and had better relative fundamentals. So whereas for a long time, not being in the big cap growth stocks was hurting them, and now it might be helping them on a relative basis. But I think the fact that their economy has sort of done okay, thanks to all the preparation and the stimulus and the different things that they've done, is showing up now in the earnings and showing up in relative returns. And now that the dollar shifted, U.S. investors that are invested in Europe are actually much happier, with a rising euro, and they've done much better. So that's why, I've been overweight Europe for a while now, somewhat overweight Japan as well. So the kind of EFI markets, the developed ex-US markets have done much better and have been holding up better on a fundamental basis than the US has or than emerging markets have. So that's been my kind of regional profile for a while now. And so we're going to have to see how that plays out as kind of markets catch up and analysts catch up and see if that continues. But that's been the play for a few months now, and could continue for a while, because it was years that the U.S. has been just the dominant factor regionally, both because of the dollar and because of relative earning strength. And I think that's now shifted for a little while, both because the Fed has been much more aggressive than, say, the European Central Bank has, and because the expectations were just so very negative for Europe for a long time. And so, kind of reversing that negative sentiment may take a while to adjust.
How much of a tailwind for European equities was the weak euro? And I actually, I mean tailwind, because even though the prices, which are denominated in euros, will be less valuable, when the euro is weak, it boosts the ability of foreigners to buy European goods. So, for example, LVMH, Louis Vuitton, they used to be able to sell a bag for $1,000. Now they can sell it for $1,200, or their input costs used to be 400 euros. Now it's 350 euros. And Japan, the currency's been extremely weak. So to what degree were those earnings helped by a weak euro? And if so, what's your outlook now that the euro is strong again, or getting less weak?
Yeah, no, I think there definitely was some benefit to the exporters from the currency, weakness that they saw, and that's kind of come off to some degree now. I think, generally speaking, corporations prefer stable currencies. So if the volatility of currencies in general kind of comes down, I think that'll be better in general for corporate profits and for the ability of analysts to forecast corporate profits. And I think the offset to that, to some degree, will be if because European companies export a lot to China in particular, into Asia. And so if China does improve, or at least stabilize, and even areas like Australia or Singapore or Japan look a little better, then I think the benefits in terms of just actual sales to some of those areas that have been under pressure may offset the currency effect that you get from the cost pressures or the currency translation effect. So I think if general global economic growth, and particularly in the weaker areas, in the Pacific, that are looking better now and have been picking up in my earnings estimate work, though that can kind of filter over into Europe for the exporters, that particularly the luxury goods and things like that they sell a lot to over there, maybe even more so than into the U.S. So I think, again, it's a rotation to some degree more than a broad scale slowdown. I think the currency will have an effect, but it's not going to be enough to offset those other factors.
So we talked a lot about what you're most bullish on. What are you most bearish on? It can be any part of the stock market, any sector, any individual stock, any location. It could also be a bond, commodity. Pick your poison.
Yeah, I think generally speaking, the areas that are weakest right now, are kind of, like I said, the big cap tech and some healthcare, and areas like utilities that I think may stay under pressure. That as long as energy prices continue to kind of stay the same or go down, I think those areas that benefit from that are going to be under pressure. I think the tech weakness will probably work itself out over the next few months. It may be too early to do that right now, so I'm still underweight some of those tech-related names for now. But I think generally speaking, the bond market doesn't look particularly attractive right now. I think a lot of the good news there has been priced in at 3.5% 10-year yields, and credit spreads have come down some. There might be a little more room for credit to improve, but I wouldn't be too heavily weighted in fixed income at this point, just because they've already kind of it's already moved a fair amount. So I think it's late to get into that party unless you really think the Fed's going to start to cut rates pretty aggressively. So I think there's probably not much more to be gained there. I think there's still risk in China. I think it's less bad than it was in terms of the earnings estimate revisions, but I don't see that being a big, long-term secular growth story. I think it's going to be a bumpy ride there as well. So in terms of what I'm most bearish on, it's more a function of things that had been doing well for a while and that are now slowing, which have been sort of the COVID winners that we're already still seeing kind of slow down. But anything tied to high commodity prices, I think is going to be under pressure. So now that doesn't mean like some things like materials, you've got things that benefit from low input costs. But I think the ones that are depending on the commodity super cycle, I think that's going to be a tough kind of argument to make over the next few years, longer term, because I think that demand is going to slow down on a secular basis.
3 topics I want to ask before we close, Sam. I want to ask about the Fed. I want to ask about the yield curve inversion. But first, just to indulge my own curiosity, I got to ask you about the home builders, which is probably the most surprising sector in terms of how strong it has been. Mortgage rates absolutely exploded because the 10-year rate went up, as well as the spread between mortgage-backed securities and treasuries widened as the Fed was doing quantitative tightening. And so totally refinancing activity, mortgage activity fell off a cliff. And housing prices, the rate of change, they started to go up more slowly, flatline, and now they're actually going down. I think actually they went down 7% over the past quarter, based on that's based on one. That's not a macro estimate. That's just one particular company. I mean, it's the biggest company in the world, Home Builder. But yeah, I mean, but the stock markets are surging close to all-time highs. I think that the ETF is ITB. What is going on in the home builders? What's your outlook? Because I mean, the prices of homes are going down. I can't imagine that the business will get better. And yes, they are cheap on a current basis, but they're not going to earn what they are. And their inventory is quoted using prices from months ago when prices were much higher.
Yeah, you're right. It's been a pretty dramatic move in some of the home builders. And some of them have come out, I think, with positive comments saying that the slowdown or the weakness is not as bad as expected. There's still some demand out there. I think activity levels have dropped off a lot. And certainly things like refinancing have dropped off a lot due to rates. But I think there's still some demand for houses. I think there's been sort of almost like a locked market for a little while. I mean, the sellers don't really want to sell because then they'd have to take on a higher mortgage interest rate, or they don't want to pay the current high prices for a new house. The buyers don't want to buy yet because they think prices will come down further. And they also are nervous about taking on a higher mortgage rate. So there's been sort of this like I say, sort of a locked market or a standoff within the housing market in the U.S. I think as that sort of eases a little bit, you'll see that there's still some demand for housing. It's not as bad as people maybe had assumed, and that because the amount of building has really slowed down a lot, there's not as much of this oversupply concern going into the cycle here as you might have had otherwise. So I think there's a bit of supply and demand going on there, and the fact that mortgage rates have come down, and people maybe anticipate them coming down a bit more. Mortgage rates went up even more than say 10-year treasuries did, proportionally speaking, because of just the way the mortgage market works. And so there's room for them to come down, kind of the spreads to narrow. And so to the extent that, again, looking at the rate of change, the second derivative, if you think mortgages are getting better, even if they're still high, that's going to help stock prices that got slammed because of mortgages a few months ago. And so I think it's more of a snapback. So things that were worse 6 months ago, 3 months ago, have now getting a bounce because things aren't as bad as expected. And that's again the same picture you're seeing elsewhere, that it's just not as bad as people anticipated, and so you're getting these big bounces. And they're smaller, they're volatile stocks, so it doesn't take a lot to move them sometimes. But they really got cheap and beaten down. I think that's what you're seeing right now.
Right. And I want to ask you about the Fed. Overnight rates are now, let's just say 4.5%. Next week, on February 1st, they will 99.999% hike them to 4.75%. The market then expects they'll likely raise another 25 basis to a top range of 5.0% at the March Fed FOMC meeting. Then the market is pricing in a lot of cuts from March 2023 to December 2024, pricing in almost 8 cuts, maybe seven or eight cuts. And if Sam, if you came on and you were a guest who had a very doom and gloom narrative about the economy, about everything's going to go to hell, and earnings are going to collapse, unemployment is going to spike up. In that scenario, I would understand the Fed cutting rates. But in this narrative where the soft landing, why would the Federal Reserve cut rates? So do you agree with the market that the Fed is going to cut? And if you do think so, does your view depend on the economy being weak?
I do suspect there probably will be some rate cuts as you get into 24. And I think it doesn't necessarily require that the economy be in severe recession. I think what will happen is that once you get past about June or so, or July of this year, the year-over-year rate of the CPI is going to come back down to sort of 2% numbers. And then it'll be much harder to say we need rates at 5% when inflation is going to be at 2%. And I think you're going to have the same kind of general picture of, saying the economy is too strong and inflation is too high. That argument's going to really weaken a lot over the next few months. And so by the time you get to the end of this year, saying we need 5% rates when real growth is 1% to 2% at best, and maybe zero, and that earnings aren't really growing anymore much, and all these other factors that would have argued for higher rates are no longer there, then the Fed's economic projections have said that in the long run, looking out 3 to 5 years, 2.5% is what they think is kind of the long run stable state fair value for rates. So 5 is actually very high. That's very tight relative to where they think sort of rates should be normally. And so again, once you get past these sort of high inflation numbers from early last year, once those roll off, it's going to be very hard to make the argument that you need 3% real rates or higher just for the economy not to have a problem. So I think they're going to make an argument for say, okay, you at least come down 100, 150 basis points just to get to sort of closer to what normal would be in a 2% inflation environment. And that's where I think we're going to be by the time you get to late this year. And so I think the Fed will then respond to that. And then the fact that I think other central banks will probably be doing similar things and start to kind of push in that direction. But I think it's not going to be much longer before this, things are too hot, inflation's too high. That argument's going to fade pretty quickly. And so I think, a 5% rate is going to look really high in a few months. And that's why I think the market's starting to price that in, is that this would be an abnormally high rate to maintain for any length of time, unless inflation was really, running out of control. And unless we get some other big shock, I don't think that's going to happen.
So yeah, where do you think inflation levels off at? And maybe I'll ask you based on the month over month basis, because you mentioned rolled off. There's base effects. In June of 2023, year over year, we'll be comparing it to June of 2022 when the price of oil was at $120. So yeah, month over month annualized, or 3 month, whatever you want to pick. I mean, where do you think it plays out at? Because the Federal Reserve has, underscored the fact that it is committed to inflation being at 2%. So do you think inflation has to, go all the way down to 2% for the Fed to cut, or go, month over month negative? Or I mean, how extreme do you think this disinflation has to get before the Fed cuts? I think it has to be pretty extreme.
I think the Fed is, kind of talked itself in a little bit of a box in terms of focusing on that 12-month year-over-year change. I think the fact that inflation has moved so fast, and all the economic data has, you really had basically a lot of inflation run up until about June of last year. And since then, it's really slowed very dramatically. I mean, the 6-month annualized is now below 2% already through December. So I think unless you think inflation is going to really reaccelerate, and that's the truth for the PPI, the CPI, even the PCE is starting to slow down. A lot of these measures are really slowing pretty rapidly. And I think, again, 2 or 3 months from now, they will have slowed more and be much closer to that 2% level if they're not there already. And that's what the market is anticipating. The inflation swaps and tips, break evens, things like that are kind of already there. Because if you look at the last 6 months, when the Fed has been, raising rates and the economy's been slowing, we're kind of already there to some degree. Now, yeah, some of that may just be because of oil prices and things that have fallen, and it may not keep falling at that rate. But I think the pressure is off. Like you said, housing prices have really cooled off a lot. That hasn't been reflected in the CPI yet because the way it's calculated, the shelter costs are lagged, kind of by construction. And the Fed knows that. And so I think, once you get to the point where everything outside of shelter in the CPI is slowing down, the PPI is, really slow, and you've got the PCE and other measures, getting close to that kind of 2% level. Again, you're going to have a hard time making the case that 5% is a necessary rate. And that's what's going to drive the argument for cuts, coming out, 6 to 12 months from now. But I do think inflation is going to kind of come back down, barring another shock. I think that's the natural kind of trend over the longer term. And then it's just a question of when the data, which is still volatile, kind of gets there to the point that the Fed will be more comfortable with it. And same thing with the labor market. But I think we'll get there over the next few months. And then it'll just be a matter of when the Fed wants to kind of shift its public stance, which is more of a PR thing than anything else.
Right. And what do you think about the inverted yield curve? Because the Federal Reserve has hiked rates so much on the short end, short interest rates are close to 5%. Long-term interest rates haven't gone up by nearly as much. And therefore, the spread between them, like the 2-year, 10-year spread, is negative. And that, as you know, is frequently cited as a harbinger of recession. And Sam, I'm a skeptical guy. Like I sort of bristle when people say, "Oh, the bond market is telling you X, the bond market is telling you Y." The bond market was extremely wrong in the latter half of 2020 and early half of 2021 because it did not foresee inflation at all. However, you would admit, I would admit that the track record of a yield curve inversion to precede a recession within, let's say, 6 to 24 months is extremely strong. So how do you interpret the inversion of the yield curve?
No, I think you're right. I think the bond market is now telling the Fed it's going too far in terms of raising rates, that it doesn't need to have rates even where they are probably now, much less, 50 basis points higher. And I think they're probably right in that regard. And so we may get a recession in the next 6 to 12 months. I think the question is it going to be a really bad one or is it going to be a mild one? I think there's a better case to be made that it would be a mild one and not one that's as extreme as you would assume based just on the extent of the yield curve inversion or even say the LEIs and things. Because again, you're kind of looking at, you had extremely high positive readings in 21 and early 22, and now you're coming off of them. So the rate of change is extreme, but the actual kind of levels of things are less extreme, meaning that we're not, the growth rate isn't that negative and probably won't be. It'll seem like a big slowdown after a very high rate of growth. And so I think there's a risk to overinterpreting the rate of change part of some of these measures, which shows up in the ISM, shows up in the yield curve, shows up in the LEIs. A lot of these things are really rate of change measures. And once you've had a very high rate of change, and then you turn to sort of a lower rate of change, that looks like a big slowdown, even if it's not in sort of real terms going to wind up being a dramatic recession. It just means that going from very high growth to zero growth will feel like a recession to some degree. But I think that's where the difference, I think, comes with past cycles, is that you've never had that extreme of a boom in a short period of time like we had post-stimulus in 2021. And so the downside of that post-boom looks very dramatic right now. But I don't think in real terms that it actually will be, because there's still some fiscal activity supporting things, and the economy is in better shape thanks to that. Balance sheets and everything else are in better shape now than they had been in past cycles. So we could probably manage this better now than in past cycles. So I think the yield curve is definitely very extreme, and that's one of the reasons I think the Fed will eventually start to cut rates, because they don't want to have it be that inverted. They know that that's kind of unfavorable for the banking system to work with. So I think they'll kind of move in that direction. They just have to kind of get the data to back them up a little bit more. And they'll get that over the next few months, I think.
Great point. Nominal growth in the U.S., the rate of change of nominal growth in the U.S. fell from 10% 2021 to, let's just say, 6% in 2022. And in that environment, oh my God, growth is slowing down. You got to buy bonds and short stocks. But no, you did not want to buy bonds in 2022. So that point is well taken. Sam, it's been great having you on. People should check out Mill Street Research. Your Twitter account is at MillST Research. My final question for you, Sam, is if your, let's just say, soft landing view turns out to be wrong, why do you think it will be? What is the greatest risk to your thesis in 2023? Will it be because inflation will end up being higher than you expect, or will it be because the recession is much deeper than you expect, or for another reason?
No, my guess is that the risk is kind of to the downside for growth and earnings and inflation. If I'm wrong and things are worse than expected, it's because the Fed's tightening and everything else has caused the economy to really slow much more than what I'm looking for, and that inflation will not be a worry anymore, and that bond yields will fall, but earnings will fall a lot more than what's already expected, and that's going to be the problem. So I'm much more concerned about looking out 6 months, a year, 18 months, being wrong because growth is much weaker than expected, then it'd be too strong or inflation comes back. Again, barring a pandemic or a new war or something like that, which I'm not really going to try to forecast. But I think the risk is that growth slows down too much rather than not enough.
Sam, thanks again for coming on, and thank you everyone for watching.